Hi, welcome to this course on infrastructure finance. This is lecture 10 and we will continue about our discussion on analysis of project viability that we did from the previous class. More specifically, in this class we will focus on the cost of capital and how we actually calculate the cost of capital, because it actually plays a very important role in determining the project viability. Before we actually get into the topic of today's lecture, we will spend some time to discuss the thought question that we put forth at the end of the previous lecture. So the question was, can you think of some real life examples which can be considered as perpetuity cash flows? Now we will try and split the questions into several parts and try and discuss each of them, because there are several important key operative words in this question. One is the term called cash flows. Now it is important for us to understand cash flows can be both an inflow and an outflow. So cash flows need not be always considered as thought of as only a cash inflow, but it can be also a cash outflow. And then we also have another important word, which is your perpetuity. So perpetuity is a cash flow that occurs for an indefinite term. In real life we probably will have very little examples where cash flows occur for an indefinite term, but for all practical purposes a cash flow that occurs for a very long period can be assumed or approximated to be a perpetuity cash flow. So from that perspective, if you look at some examples of perpetuity cash flows, we can think of several. The most common example that one could remember is what is called as your pension. So when you actually receive pension, the pension is a regular payment. In most cases it occurs every month and it occurs for an indefinite period. That is, we are not very sure when the pension is going to stop, because the pension keeps coming as long as the holder of the pension policy is alive. So it is more frequently modeled as a perpetuity cash flow. Another example of a perpetuity cash flow could be, let us say, the professional tax that we pay on our salary income. So as long as you are actually going to earn your salary income, one is obliged to pay what is called as your professional tax. So this is a fixed amount that we would be paying for each and every month. So this is in a sense what is called as your perpetuity cash outflow. It is called a perpetuity because it is going to happen for a very long period of time. As long as one is continuing to earn a salary, we are going to incur this professional tax outflows. So this is your perpetuity cash outflow. Now are there any other examples in the context of infrastructure projects which we can model as perpetuity cash flows? In many cases infrastructure projects have either a long duration or it actually has concessions that actually stretches several years into the future. So today you have, let us say, the Bangalore International Airport project. There the concession or the license given to the private operator to operate the airport is for about 60 years. So 60 years is a fairly long duration. So the cash flows that occur during such a long duration can be modeled as a perpetuity cash flow. But we will have to make some approximations when we talk about a perpetuity cash flow. One is, we assume in many cases, though it is not uniform, we assume the cash flows to be uniform. Second, if the cash flows are growing, we kind of assume that it grows at a constant growth rate. For example, we assume a 2% growth rate, 3% growth rate and so on. That actually makes it possible for us to model cash flows that occur over a long duration as a perpetuity cash flow. So several projects, for example a power project will continue to generate power for 25 years and 30 years, and this is a fairly long duration, and in many instances we can actually model the project cash flows as a perpetuity cash flows. So there are several examples in real life, and more so in the case of infrastructure projects, where because of the long duration of the project cash flows we tend to model them as perpetuity cash flows. They may not be really indefinite, but because of the fact that they occur over a long duration of time, we kind of model them as perpetuity cash flow. Now let us go to the topic of the day, which is to really look at what is the cost of capital. Now what do we actually mean by cost of capital? In our previous lecture we talked about the time value of money. In the time value of money we simply said that cash flows that accrue in the future need to be discounted to the present, and we need to actually sum up all the cash flows, all the future cash flows in present value terms, and that actually gives the sum of all the benefits from the project. Now if you really look at it, we calculate the present value of a cash flow from the future. So we have the future value at time t, and we determine the present value of this cash flow by dividing by the discount rate, where k is your discount rate. And t represents the time of your cash flows. So when we actually discount the future cash flows by a discount rate, we get actually the present value. Now the question is, what is this discount rate? So this discount rate is referred to as the cost of capital. See, for example, capital is considered as a commodity or a good. Like any other good that we actually purchase from the marketplace, which actually has a cost, when we go ahead and seek capital, the capital also has certain amount of cost. So that is actually referred to as the cost of capital. In simple terms, an investor who is planning to invest in the project, he expects two things. The first thing is he expects to get a return of his capital, and second, he expects to get some amount of return on the capital that he has invested in the project. So the return that the investor expects is in a sense referred to as the cost of capital. So the investor needs to be compensated for the capital that he provides to the project, and this compensation is the return that he expects from the project, and from the borrower or from the capital seeker perspective, the return expected by the investor is the cost of capital. Now there are other ways also to look at it. For the investor, the amount that is invested in the project represents what is called as your opportunity cost of capital. If the investor has not provided money to invest in the project, then he would have probably invested the capital elsewhere, and he would have obtained some returns from making that investment. Now the cost of capital is essentially the opportunity cost that the investor would have lost from investing the capital elsewhere because of investing in the current project. Now what will be the cost of capital in that sense? The cost of capital in that sense would be the return that you would have got elsewhere in the sense that elsewhere of a project which is very similar in nature. So when we are comparing investment opportunities, or when we are comparing opportunity costs, we are trying to compare opportunities of a similar nature, of a similar risk, and so on. Now for the investor, when he is actually calculating the opportunity cost of capital, he has to really compare opportunities of a similar type. So the opportunity that he would have lost because of investing in the proposed project is his opportunity cost of capital, and that is usually referred to as the expected return of the investor. In other words, it is also called as your hurdle rate. Hurdle rate indicates that that's a minimum return that the investor would expect for investing in the project. If a project is expected to give a return that is less than the hurdle rate, then the investor is not getting adequately compensated for providing capital to this project. So, the minimum return that an investor would expect is called as your hurdle rate, and this hurdle rate represents the opportunity cost of capital, and to some sense it also represents the expected return by the investor. Now, what determines the cost of capital? Remember, we talked about discounting the future value to the present, and we are trying to understand what determines this cost of capital, what determines the discount rate. Broadly, it can be looked at it from two perspectives. One is what features of the project determines the cost of capital, or what features of the project influence the cost of capital. The fundamental concept that determines the cost of capital is called as your project risk. Remember, in the world of finance, an important correlation is between risk and return. So, you have risk of the project and then you have returns from the project, right? Risk of the project and returns from the project. So, these are directly proportional, right? These are directly proportional. So, if the project is considered to be more riskier, then the investors would also expect a higher return from the project. On the other hand, if the project is less risky, then the investors are satisfied with a lower return. So, this is a very important relationship that you should be aware of, the relationship between risk and return. Now, if the risk increases, then the return expectation also increases, and therefore the cost of capital for the project also increases. When the investors start expecting higher return, then as a finance manager for the project, you will have to factor that as a higher cost of capital for your investment. So, project risk is an important feature that actually determines your cost of capital. Now, what is project risk? There are several ways in which you can actually look at project risk, but fundamentally risk is something that leads to an uncertainty in cash flows. So, when the project is said to be more riskier, what we are essentially meaning is that the uncertainty in the cash flows are higher, and when there is more uncertainty, the project is perceived to be more riskier, and therefore the investors are expected to demand or seek a higher return. So, if we can actually by suitable methods or contracts, we are able to reduce the uncertainty in cash flows, then the project is supposed to be less riskier. Now, there are several ways in which you can mitigate the uncertainty in cash flows. For example, in the case of a power generation project, if the power generation project has been able to sign a power purchase agreement with a buyer of power, and if the buyer of power is supposed to be reasonably creditworthy, then the risk, the uncertainty of revenue on the project is considerably reduced. So, in essence, this also reduces your project risk. Similarly, if you are able to find out ways in which we can mitigate the project risk and which increases the certainty of the cash flows through any other means, for example, it could be by way of a very strong concession agreement, it could be by way of a very strong fuel supply agreement in the case of a power project. Let us say in the case of a power project, availability of fuel plays a very important role. If the fuel is not available, then the power plant cannot operate, and for the plant to generate revenues, it is very important for ready availability of fuel. So, if we have a fuel supply agreement that ensures availability of fuel, then the cash flows to the project becomes all the more certain, and when you have certainty in these cash flows, the project risk becomes reduced. The second feature that determines the cost of capital is your duration of investment. That is, for how long do you actually need the capital. We have projects of short term duration, we have projects of a long term duration. So, investors generally expect a higher return from a long term investment as compared to a short term investment. All things being the same, an investor would expect a higher return from a long term investment, that is, if the project is actually going to give returns over a longer period of time, then the return expectations would be higher, the cost of capital also would be higher. So, if a project is, let us say for example borrowing for an 8-year period, the interest rate generally expected to be higher as compared to borrowing for a 3-year period. So, if we need long term capital, then we also would need to be in a position to have or service a higher return for the investors of those instruments. We go to the next feature. The sources of capital also determine the cost of capital. So, broadly, what are the different sources of capital? If you look at the source of capital, they can be classified into two categories, equity and debt. So, when you actually want to attract investment for a project, you can either get it by way of equity or you can get it from debt. Now, where you actually get the capital also determines what is going to be the cost of capital for your project. So, between these two sources, equity is more expensive, that is, equity investors would expect a higher return as compared to debt investors. Debt is cheaper. There are various reasons as to why debt is cheaper as compared to equity, but at a very broad level at this stage it is suffice to understand that equity is expensive as compared to debt. So, therefore, if you are able to fund the project with substantial amounts of debt, we will actually have a cost of capital that is lower as compared to financing a project with substantial amounts of equity. So, how we source of capital also plays an important role in determining your cost of capital. So, now after having discussed what influences cost, we will try and actually spend some time to understand how do we actually find out the cost of different sources of capital. First, let us look at cost of debt. So, determining the cost of debt is generally considered to be easier, because we know very well that what is a return that debt investors expect. Debt investors expect a certain amount of interest on their investment, and so this in a sense represents the cost of capital of debt. And so essentially when you look at getting debt, the cost of debt is nothing but the interest rate on the debt. But we will have to understand an important feature here, that is, when you are actually paying interest on debt, the interest that we actually pay gives us certain amount of tax shields for the borrowing company. So, we will have to account for the tax shields that we get by paying interest in calculating your cost of debt. So, let me explain the concept of the interest tax shields. So, let us assume that there is a company which is very similar in nature, but differs only by the way in which it has been financed. Let us say there is a project which costs 1000, and there are two companies that are involved in implementing this project, and they differ by the way in which the project has been funded. Let us say there is company A and company A has funded this project entirely by equity. So, the entire 1000 needed for implementing the project has come from equity, and then there is company B which has obtained debt, and only 200 of the project is funded by equity, and then the remaining 800 is funded by debt. So, the total investment in both the cases works out to be 1000. So, both the firms have implemented the same project, the only difference being how it has been funded. So, now let us assume that the revenues are also the same because the project is the same. So, both the companies actually have the same amount of revenues, 1000. For the sake of simplicity, let us assume that the expenses are 500, all the operating expenses amount to 500, and therefore, the profit before interest and tax works out to 500. Now, for a company which has actually borrowed a certain amount of capital, it has to pay an interest, and if we assume the interest on debt is 10%, if you assume the interest in debt is 10%, then the interest paid by company A is nil because the company has not borrowed any capital, and the interest that is paid by company B is 80 because the company has actually borrowed 800 and 10% of 800 is 80. So, this leads to a situation of profit before tax of 500 in the case of company A and 420 in the case of company B. If we assume tax for the sake of simplicity is 50%, the profit after tax will therefore be 250 in the case of company A and 210 in the case of company B. Now, what do we actually see here? So, company A has paid a tax of 250 and company B has paid a tax of 210. So, if you really look at it, company B has saved tax to the certain to the extent of 40. So, tax saving by company B is 40. Why has this tax saving happened? The tax saving has simply happened because the company has paid an interest of 80 and this interest payment reduces the amount of tax that the company has paid. Okay. So, because of this tax saving of 40, the net interest that the company has paid is be 80 minus 40, that will be equal to, the company has actually paid an interest of 80, but because of this interest payment it has actually been able to enjoy a lower tax to the extent of 40. So, therefore, the net interest the company has paid would be 80 minus 40, this is 40. So, if you use the net interest as 40 on a total debt capital of 800, so we actually get the interest after tax would be 40 divided by 800, this will be equal to 5%. So, the net interest after considering the tax shields for the company is only 5%. So, this represents the after tax cost of debt. Okay. So, after tax cost of debt is 5%. So, this is nothing but the pre-tax cost of debt 10% multiplied by 1 minus your tax rate. So, we have assumed the tax rate to be 3%. So, in essence the post tax cost of debt, okay, cost of debt I am denoting by KD, and then post tax is nothing but the cost of debt pre tax multiplied by 1 minus your tax rate. So, whenever we are using the cost of debt, we should always account it on a post tax cost of debt. So, yes, cost of debt is nothing but the interest that is paid, but because the interest enjoys a certain amount of tax shields, we use the post tax cost of debt. Next, let us go back to finding out the cost of equity. So, unlike debt where the cash flows are contractually specified, so when you actually borrow you clearly specify that you will be able to pay 10% interest, 8% interest, 6% interest and so on. Unlike this contractually obliged payments in the case of debt, equity does not involve any contractual payment obligation. So, therefore, it becomes very difficult for us to directly calculate the cost of equity. So, a common model which involves to estimate cost of equity is your capital asset pricing model. So, the procedure for estimating the cost of equity is very different as compared to the cost of debt, simply because of the fact that it is not possible to clearly identify a number because of the lack of contractual payment obligations. So, what is this capital asset pricing model that we talk about that can be used to estimate the cost of equity? So, capital asset pricing model is a very simple model which estimates the cost of equity by this expression. The cost of equity is nothing but your risk free rate of return plus your measure called beta multiplied by RM, which is the rate of return obtained from a market portfolio subtracted by your risk free rate of return. So, we can use this expression to estimate what will be the cost of equity, but before that let us understand what are the different terms constitute. So, RF is nothing but the risk free rate of return. So, where can we actually get information about the risk free rate of return? So, first of all we will have to assume, we will have to find out an instrument which can be considered to be risk free. That is, if you are making an investment in that instrument, there is no risk for the holder of the instrument or the holder of the security. So, the contractual payments that are supposed to occur will come and the investor is not exposed to any uncertainty in terms of the cash flows. So, a risk free instrument is essentially considered to be a financial instrument or a bond issued by the government. Any security that is issued by the government, any bond security that is issued by the government is considered to be risk free, because generally assume that the governments do not default on their payment obligations. I mean, there has been instances where governments have defaulted, but it has been a very rare instance. Governments of countries that are considered to be creditworthy do not default. So therefore, we assume the interest rate on the bonds issued by the government as the risk free rate of return. The risk free rate of return could actually vary from government to government. For example, the rate of return issued by a US government bond is going to be different from the rate of return that we enjoy on, let us say, a bond issued by the Indian government. Bonds issued by the Indian government for a variety of reasons might actually give higher return as compared to bonds that are issued by the US government. In essence, both the bonds are risk free, but because of certain other factors, there is a difference in terms of the risk free rate of return. So which risk free rate of return should you actually take? So you should take that rate of return where the project is going to be implemented. So for example, if you actually going to implement the project in India, then you should actually take the risk free rate of return that are prevailing in India. So you could probably get information about the risk free rates of return in the markets or from any of the other financial information sources. Next is your beta. So beta is nothing but a measure that captures the risk of a particular security vis-a-vis the market. So to understand beta, let us understand it by a simple graph. So this is a graph where we actually try and capture, let us say, the market returns and then we capture the returns on the security that we are interested in. So if we plot a graph between the market returns and the returns on the security over a period of time, we could probably get a line something like this, and so the slope of this line is tentatively the beta. So this measures the sensitivity of the securities return as compared to the market returns. Now if beta is considered to be a value of 1, then the security gives a return that is in tune with the market return. So if the market gives a return of 10%, then the security will also be giving a return of 10%. So that actually means that beta is 1. If the beta is more than 1, then the security gives a return that is higher than the market returns. If the market gives 10%, then the security will give 12%. So when I mean by security, I actually mean the equity of the company that we are interested in. When beta is less than 1, then we are having a scenario where the equity is actually giving a lower return as compared to the market return. So beta is essentially a measure of the risk of the equity as compared to the market. Okay, so that is beta. And then we have returns on the market portfolio. RM is nothing but returns on the market portfolio. So over a period of time, market gives certain amount of returns. So if we actually make an investment in a list of securities, in a list of equities that comprise or represents what is the market, then the returns that we get from such a portfolio is called as your market returns. So when you talk about market returns in India, we look at several stock market indicators. So, we have the BSE Sensex, then we have the various national stock exchange indexes. So, they are all nothing but a market portfolio. So, the return that we get by investing in such portfolio would be called as your market returns, and market returns net of the risk free rate of return multiplied by beta plus your risk free rate of return would give you the estimated or expected value for cost of equity. So, this term RM minus RF is also denoted by what is called as your market premium. You are actually having a risk free rate of return. How much are you able to get more by investing in the market, because investing in the market carries a certain amount of risk as compared to a risk free premium, as compared to an instrument that offers riskless return. So, how much premium does the market give as compared to the risk free instrument? So, that is your market premium. So, we simply use this expression to calculate your cost of equity capital. Next, we will have to understand a third component, which is called as your weighted average cost of capital. Remember, a project can actually get investment from both equity and debt. There is a cost to debt, there is a cost to equity. Now, how do we actually determine the cost of capital for the project, because capital is obtained from both equity as well as debt. So, then that is what we actually have to encounter, what is called as your weighted average cost of capital. How do we calculate the weighted average cost of capital? So, weighted average cost of capital is nothing but cost of debt on an after tax basis multiplied by the proportion of debt funding that we use for funding the project. So, let us assume D is the amount of debt that we have used, and the total funding for the project is nothing but debt plus equity. So, this ratio D by D plus E represents the proportion of debt funding that we actually have to use for the project, plus cost of equity multiplied by the proportion of equity funding that we use for the project. In essence, this is nothing but a weighted average cost of both debt and equity, that is simply the weighted average cost of capital. So, when we actually have to determine what is the cost of capital that we have to use, then we will have to use a weighted average cost of capital, because this indicates, this is a hurdle rate that the project will have to meet to satisfy the investors' expectations. Let us do a simple illustration to calculate the weighted average cost of capital. Let us assume that we have a project with the following features. The risk free interest rate is 8%. Again, as I was saying, the risk free interest rate keeps varying from time to time, it keeps varying from country to country. So, we will have to choose the approximate indicators prevailing at the time that the project is being implemented to identify what will be the risk free interest rate. And then we have information about equity beta, which is 1.2. We do not have to actually calculate the beta ourselves. For example, there are several sources which actually gives you beta of an equity. So, there are financial information portals like Yahoo Finance or MSN Finance, which actually gives you the beta values for several publicly traded stocks in the global markets. So, we could actually obtain the beta information from these external sources, because trying to calculate or determining the beta ourselves is going to be a fairly time consuming exercise. Then we have indicator about market premium, which is 8.4%. So again the market premium differs from market to market. In some developed countries the market premium will be a little lower, but in developing countries the market premium could be a little higher. On an average, a market premium is assumed in a very general sense to range between 6% to 8% on an average. Then we have a pre-tax cost of debt at 10%. The total proportion of debt financing for the project works out to be about 80%. So out of the 100%, 80% of the cost is met by debt sources, and obviously this means that the remaining 20% is from the equity source. And then we have an income tax rate of 35%. So let us try and calculate using this information what should be the weighted average cost of capital for this particular project. So first we will have to calculate the cost of debt. And remember, we have to calculate the cost of debt on an after tax basis. So this is after tax cost of debt. So after tax cost of debt is nothing but cost of debt multiplied by 1 minus your tax rate. So if we substitute the values that we have for this example, then cost of debt is 10% multiplied by 1 minus tax rate, which is 35%. So the after tax cost of debt works out to be 6.5%. Now we have determined the cost of debt. Let us now determine the cost of equity. Cost of equity. So cost of equity, we try and use the capital asset pricing model to determine what is going to be the cost of equity. So cost of equity KE is nothing but your risk free rate of return plus beta multiplied by your market premium. If we substitute the values that we have for this particular project, then the risk free rate of return is nothing but 8% plus your beta is 1.2 multiplied by a market premium of 8.4%. So this actually gives you a cost of equity of 18.08. Now after having obtained the cost of equity and cost of debt, we will have to find out what is your weighted average cost of capital. So weighted average cost of capital is nothing but after tax cost of debt multiplied by the proportion of debt plus cost of equity multiplied by the proportion of equity. If we substitute these values, we are going to get 6.5% is the after tax cost of debt multiplied by 80%, which is the proportion of debt used for the project, plus the cost of equity is 18.08% multiplied by the proportion of equity for the project, which is your 20%. And if we calculate, this works out to 8.82%. So the weighted average cost of capital is 8.82%, and if the project is able to provide a return of 8.82%, then it will be in a position to meet the return expectations of the investors. So this brings us to the end of this lecture, and before we close, a couple of thought questions. Question number 1, why do we generally consider debt to be cheaper than equity? What is the reason? What is the principle behind debt being cheaper than equity? Question number 2, how do we get the values of equity and debt for calculating the weighted average cost of capital? Remember, in weighted average cost of capital we find the proportion of debt funding or the proportion of equity funding by the values of debt and equity. So how do we get the values of this equity and debt for calculating the WACC? Further reading on this topic, you can refer to chapter 7 on the discounted cash flow analysis in the project financing handbook by John Finati. Thank you.